fundamental financial management CPA and fundamentals of finance diploma ATD, written by CPA McCann. This is a very important book. It has a lot of input, and if you need it, you can reach to us, and I will be able to organize to see how the same in the textbook is able to reach you. Thank you so much. Let's begin our class. Yes, we are still continuing with the business valuation, whereby we say that business valuation is the process by which we are determining the value of a given security. And we said security is purely about the assets one is owning or controlling. That is to say, we have the property, plant and equipment. We have also the shares, that is ordinary shares, preference shares, and we have also the debt, the bond itself. So today we want to discuss about valuation of shares. So under business valuation, we are discussing about valuation of shares. Valuation of shares. Valuation of shares. Valuation of shares. First, we have already discussed about methods used to carry on valuation, and today we have to discuss about valuation of shares. Valuation of shares here, we are talking about the market price or the market value or the capitalization value of ordinary shares and preference shares. So in this note, let's begin with the A, valuation of ordinary shares. Now the ordinary share, these are actually shares contributed by the shareholders of the company, whereby each and every person is contributing some amount of money to start by that particular business, to boost the capital of that particular organization. That contribution towards the starting that particular organization is what they call ordinary shareholders. Ordinary shareholders in most cases result to what we call ownership, shareholding interest. So if you have contributed some amount to a particular company for the sake of owning particular number of shares, that is what we call ordinary shares. Ordinary shares are actually permanent in the organization. Once they have been contributed, they will remain permanent for a certain period, for the rest of their life, for the rest period of that particular entity. That means it will not be withdrawn at any given time. And for that reason, the shareholders who have contributed this particular ordinary share capital will be enjoying what we call returns. Returns in the form of dividends and what? Capital gains. So in this case, you want to discuss about the returns itself. In this case, returns called what? Ordinary shares. Now, in this case now, these returns called dividends from the ordinary shares are actually paid after preference shares dividends. You remember we have preference share dividends. So we only pay the dividends, ordinary share dividends, to the shareholders once you have paid the preference share dividends. Why? Because preference share dividends are just like the liability to the organization. So we don't own, but the owners of the entity will actually pay themselves after all other liabilities have been settled. And therefore, we want to discuss about the ways in which dividends of that particular entity is able to be distributed among the owners of the company called ordinary shareholders. In this case now, let's start with the ways in which dividends are distributed. There are three ways in which dividends can be distributed in this particular area. Like number one, we can now state number one, zero dividend. Zero dividend growth rate. So the dividends to the ordinary shareholders can be distributed in the form of zero dividend growth rate. This statement means that dividends given to the shareholders does not affect or does not give to the any growth in the future. Meaning that the current dividends we are paying today will remain constant or unchanged over a certain period of time. So therefore it's called zero dividend growth rate. There is no growth at all. For example, in this case, if the current dividends D0, current dividends for this particular year is D0, then the dividends after 1 year will be D1, will be equal. And the dividends after year 2 will be the same also. And the dividends after year 3 will be the same also, and also to NDN0. Therefore, it means that there is no growth of dividends. So the company is paying a constant amount of money to them, constant amount of dividends to the shareholders over a certain period of time, and therefore it is calculated as D0 current dividend is equals to dividend after 1 year and equals to dividend after 2 years, is equals to dividends after 3 years and equals to dividends after n years. For that scenario, it means that for that case now, for us to calculate now, dividends will remain into infinity. Therefore, you can say present value of annuity to infinity for that particular dividend is now the dividend amount. That is to say the amount that has been set aside for distribution as dividends, then divide by the cost of equity. So in this case now, present value of annuity to infinity, which is in this case now is the value of the ordinary shares under dividends. So the value of the dividends now is present value of annuity to infinity is dividend amount divided by cost of capital. And this dividend, if you now split these dividends into shares, then it will be dividend per share divided by the cost of equity. So therefore, for us to find out the market value of the shares of the dividends, it should be DPS over cost of equity. So KE stands for cost of equity. So in this case, it is called cost of equity. So cost of equity is represented by KE. Another form of dividends that can be distributed by the organization to the entity is what we call dividend growth rate. Dividend growth rate. In this case, dividends are paid to the shareholders every period, but they are growing every year. So for example, in this case now, the formula, we are using the same formula, but we are now to say if there is growth, assuming now we have year 1, maybe the dividends after year 1 will be now D0. D0 is the current dividend into 1 plus that growth rate per year 1. You will get the value, which means it has grown by that particular. But now dividend growth rate means that this dividend is remaining what? Constant. Dividend growth rate constant. So the growth rate is remaining constant. Maybe in year 2 it can also be D0 into brackets 1 plus G power 2. If it is grade 3, if it is a year 3, it will be D0 into brackets 1 plus G power 3. Then you get the value. Now on that note, that is how to get that. Then if it is, we have also 4 years, it will be D0 also into brackets 1 plus G power 4. Therefore, if dividends are growing annually by constantly, it will be calculated like that. Now, on this note, this is what we call what? Dividend growth rate at a constant proportion. Now, we have the last one. We have the last one now. The last one is called number Roman 3 is called non-constant dividend growth rate. In this case, the growth rate is not constant. It keeps on changing. For example, for year 1, it grows by maybe 1%, 10%. In year 2, it grows by 15%. In year 3, it grows by 20%. And in year 4, maybe by 25%. So therefore, it means that non-constant dividend growth, the growth rate is not constant. But for the second one, the growth rate is remaining what? Constant. And for that reason, this one means that maybe for the certain period of time, the dividends will keep on changing per period. So we are going to see now the 3 methods in our computations. So the 3 methods in our computations. Let's see examples. So remember, I said that the examples are purely in our YouTube. So I'll be posting this video together with the notes and the questions that are following each other. So kindly, if you want to benefit from these notes, go to our YouTube, search CPM Akan SIPS College. You'll find these notes, define this topic there together with the notes. So let's see example there. Example 9. If a company is considered to be a going concern and it promises to pay constant dividends per share each year of 6 shillings and the cost of equity is 8%, what is its theoretical value of the company's share? Remember, when I was introducing this topic, I said that the theoretical value or the theoretical price is the same as real value, is the same as intrinsic value, is the same as capital value, capitalization value. So ensure that you capture the formula, the terms correctly. Either you can use the word theoretical value or intrinsic value or real value, or you can also use capitalization value or market value. They mean the same. So those terms are very important when it comes to custom questions. So let's see this question. That is example 9. Yes. If a company is considered to be a going concern and it promises to pay constant dividends per share each year of 6 shillings, there will be a payment of dividends 6 shillings per year constantly. Okay? And the cost of equity is 8%. What is the theoretical value of the company's share? First of all, we understand the question. Theoretical value, which is P0 now, is given by D0 over KE. Then D0 is the current dividend, which will remain constant. This dividend for the current dividend will be equals to D1 and will be equal to D2 and will equal to D3. So it will remain constant for the rest of the organization. Now, therefore, cost of equity, we have already been given as 8%. Therefore, this will be now, D0 is 6 shillings divided by 0.08. So your answer there is 75 shillings. You can see how to calculate that. Example 9. Example 9. Before I go to example 9, sometimes this cost of equity here, so not cost of equity, but this theoretical value P0 can easily be affected by flotation. When we talk about flotation, we are talking about costs that organization incurs in the process of securing loans or finances into the organization. For example, if you are applying for a loan, that means that you will incur the costs for 1, processing of that loan. 2, we have the risks there. 3, we have also the lawyer who is coming to guarantee the loan you are acquiring. Therefore, this additional cost that will come together with it, that comes together with what? A loan is what they call flotation cost. Therefore, flotation cost will actually affect the value of the asset or the value of security. Therefore, in that case, this value here will be affected by what? Flotation cost. For that case, it means that if I want now to affect the flotation cost, it will be P0 minus that flotation will give me what? D0 over KE. And I can still change and say this is treated as 1, therefore I multiply this. It gives me KE is equals to D0 over market value or theoretical value minus what? Flotation. So in case there is a question that is relating to flotation cost normally affects the market price or a theoretical value. So let's see now how this question is going to affect. The second question is about the constant dividend growth rate. So the dividend is growing at a constant rate, which means this year 10%, next year 10%, the other year 10%. It will be growing like that. But in this case now, there will be change in terms of growth rate. And therefore, I've said, in that case now, we are going to see how to apply that. Let's see an example 10. Example 10 says, a company expects to pay 6.5 shillings as dividend per share at the end of the year. These dividends are expected to increase at a constant growth rate of 7% per annum until infinity. If the cost of equity is 20%, determine the theoretical value of the share. So first and foremost, you have to ensure that you have understood the question, especially the dividends. Is it paid at the end of the year, or it has been paid already at the beginning of the year? If it has already been paid at the beginning of the year, we call it current dividends. But if these dividends will be paid after the end of the year, which means that is what? Dividend after year 1, D1. And for that case, you have to be very careful. Let's see the question. A company expects, that is how it is beginning. That's how the question is beginning. To pay 6.5 shillings as dividends per share at the end of the year. Which means it is not the current dividend, but the dividend after year 1. Therefore, we call it D1. And how do you get D1? For that example 10, D1 is calculated by D0 into 1 plus G power 1. This is what we call D1. So this one will give you your D1. If you want to get D2, it will be D0 into brackets 1 plus G power 2 will give you D2. Therefore, the dividends are paid at the end of the year. That means at the end of year 1, but not at the beginning. So therefore, let's analyze the question. These dividends are expected to increase at a constant growth rate of 7% per annum until annuity. If the cost of equity is 20%, determine the theoretical value. So therefore, let's extract information. So instead of D0, this one is D1. This one is D1, which is 6.5. Then they are also saying there is a constant growth rate of 7%, which is 0.07. Then we have also been told there is what we call the cost of equity, KE, which is 20%, 0.2%. So therefore, we are being asked to calculate the theoretical value. Therefore, theoretical value P0 is given by growth rate, which is D0 into brackets 1 plus G divided by cost of equity minus G. And because already this one here represents the dividends after year 1, so I will say equals to D1 over cost of equity minus G. This one is already this one. So your answer there is cost of dividend. I've already been given the dividends, which is 6.5 divided by cost of equity 0.2 minus growth rate of 0.07. If you multiply this answer by 100%, your answer that you are likely to get is not 100%, sorry, not 100%, because you are getting the value, will give you what? 50%. 50 shillings, sorry, 50 shillings. Example 11. Example 11 is saying a company has paid, which means D1. If it says it expects to pay, that is D1. But if say has paid, it means D0, current dividend. A company has paid 12 shillings as dividend per share. These dividends are expected to increase at a constant growth rate of 10% per annum until infinity. If the cost of equity is 15%, determine the theoretical value. So they are saying the company has paid 12 shillings per dividend, which means that is D1, current dividend. If you go to the previous question, they are saying a company expects to pay. Therefore, it is telling you these two questions are different. Expect to pay, meaning that it has not been paid, but will be paid by the end of the year 1. That is D1. But if the company has just paid, it means that is D0. So for that case, number 11, I will now say yes, D0 is equals to 12 shillings. Correct? Then growth rate 10%. G is equals to 10%, which is 0.1, comma. Then I can now say cost of equity is equals to 15, which is 0.15%. Now, calculate the theoretical value. In this case, now you say, theoretical value is given by D0 into brackets 1 plus G over cost of equity minus G. Now, because this D0 has not been, this one is D0, so we'll substitute here. But this question was saying already D1 has been given, so that's how we are moving like this. Now for me now to get the D1 here, I will substitute now by saying this will give me 12 into brackets 1 plus G. G is 10%, which is 1.1 power, divided by cost of equity 0.15 minus cost of growth is 0.1. So if you substitute this question, your answer you are likely to get is 264 shillings. So this one here is very, very, very important. Example 12. A company expects to pay 13 shillings as dividend per share at the end of the year. That is D1 or D0? That is D1. Why? It expects to pay. So that is D1. So you say now D1 is 13 shillings, correct? The current market price per share is 100 shillings. Current market price per share 100 shillings. What does it mean? That is the value of the shares. Now P0 is equals to 100 what? Shillings. So in this question you have already been given the market price, but from question 11 you are calculating the theoretical value. Then the dividends are expected to increase at a constant growth rate of 2% growth. G is equals to 0.02. Determine the cost of capital. Now in this question, they want you to calculate the cost of capital. So therefore you say, how do we get this? P0 is equals to D0 into brackets 1 plus G over cost of equity minus G. So they want us to calculate the cost of equity. We substitute now. P0, that is the market price, 100 shillings, is equals to dividends 13 into brackets 1 point, growth rate 0.2, or divide by KE minus 0.02. This is 1. Now what do you do there? Cross multiply. Cross multiply. This one goes there. This one comes down. So this one will give you cost of equity minus 0.02 will give you what? 13 divided by 1 times 1.02 divided by 100. Now, for that matter, you will get now cost of dividends. If you multiply this one by 100, what do you get there? Oh, sorry. There's a mistake I've done. Sorry. There's a mistake I've done. Let me correct there. Sorry. Now, the mistake I've done is this. This is D1. So this one is equals to D1 over KE minus G. So therefore, my substitution will be 100 is equals to D1. Instead of now, you see, I wanted to get the difference between this question and this question. Now, D1 is now 13 over cost of equity, which I have been asked to calculate. Like that. Then cross multiply, like that. This gives you KE minus 0.02 is equals to 13 over 100, or is equals to 0.13. Therefore, cost of equity minus 0.02 will give you what? 0.13. So this one crosses the other side. KE is equals to 0.13 plus 0.02. This gives you what? 0.15, which is the same as what? 15%. Therefore, it tells you that the cost of equity is 15%. Is 15%. Therefore, NB, for us to calculate the growth rate, which is very important, very, very important, growth rate is calculated by dn over d0. You get the root of n, you subtract 1. Now, D0 is the current dividend, which means the dividends for that particular year. Then, this DN is the dividends after n years, which means after periods in the future. Then N here is the number of years. And then 1 is a constant. Now, therefore, this, for you to get the value N there, you must subtract 1. So if you subtract 1 now, you put the figure there. Like from the previous question, we said that if you have been given 5 years, you subtract 1, you get what? 4. Therefore, it will be root 4. If it is 6 years, you subtract 1, you get what? 5. Here will be root 5. And we want to see questions of the same nature as we move on. So let's see from the question given, question 13. Question 13. Question 13 says, a company has been paying a gradual increasing dividend per share over the last 5 years as shown below. The last 5 years. So N there will be 4 years, not 5. Then year there, and then DPS there. Year 2020x8, 6.6, 20x7, 6.25, 20x6, 5.85, 20x5, 5.5, then 20x4, 5.243. Required, Roman 1, determine the average dividend growth rate, that is G. Roman 2, if the cost of equity is 14%, determine the intrinsic, so they are changing the term. The previous examples, theoretical value. This one is intrinsic value of the share as at 31st December 20x8. So therefore you are supposed to ensure that you check the years. 20x8 and 20x4, which means 20x4 is purely the current year, and then 20x8 is purely dn. So therefore let's work out on the question. Roman 1 is calculation of dividend growth rate. Dividend growth rate. So therefore G is given by dn over d0 root of n minus 1. So dividends dn is now 20x8, which is 6.6. Then d0 is the current dividend. In this question, the current year is 20x4, which is now 5.24. Then you get the root. How many years are here? So 1, 2, 3, 4, 5. Instead of now writing 5, you write what? 4. Then you get the root of 4. Then you subtract 1. If you work out that question clearly, your answer you're supposed to get here is 0.06, which is the same as 6 what? Percent. Roman 2. Roman 2 is saying, if the cost of equity is 14%, determine the intrinsic value of the shares as at 31st December. Intrinsic value. So therefore P0 is given by D0 into brackets 1 plus G over KE minus G. Now look at what is happening. D, the one that we have been given. We have been given D hit 0 here. By the end of which year? 31st December 20x8. Therefore it means that D0 you go to the year 20x8. You substitute there. Therefore it will be, your work will be very simple. 20x8 is 6.60 into brackets 1 plus G. G is now 6.06. Divide by cost of equity is 0.14 minus growth rate 0.06. So if you work this correctly, your answer you're supposed to get is 87.45 shillings. If you work out that, you are able to get that particular element. Example 14. A company has been gradually increasing DPS over the last 5 years as shown below. 20x8 7.3, 20x7 6.5, 20x6 6.00, 20x5 5.50, and 20x4 5.00. So you ask yourself, which one is D0? D0 is the current year. In this case, the current year is 20x4, and Dn is the 20x7. So question Roman 1 or A. Determine the average dividend growth rate. So they want you to determine growth rate. So growth rate there is given now by Dn. Dn, that is 20x8. So you get 6.6 divided by D0. That is what? No, sorry. This is 7.30. Then D0 is 5.5.00. Root of, there are 5 years, so you subtract 1 to get 4 minus 1. So what is your answer? If you calculate this one carefully, your answer you're supposed to get is 10% or 0.099, which gives you what? 10, average of 10%. Then Roman 2. If the cost of equity is 16%, determine the intrinsic value. So intrinsic value P0 is equals to D0 minus into brackets 1 plus G over cost of equity minus G. So in this case already, by the end of which year? 31st December 20x8. So you go back to that 20x8, which is 7.3. So therefore, you substitute now 7.3 into brackets 1.1 divide by cost of equity 16. 0.16 minus 0.1. So if you work out this carefully, your answer you're supposed to get is 133.83 shillings. If you work out that question correctly. The following example also, that is example 15, is about now the non-constant dividend growth rate. Non-constant dividend growth rate. Non-constant dividend growth rate is a question that is frequently tested. It is actually building up from zero dividend growth rate to constant dividend growth rate, then to non-constant dividend growth rate. So this question is actually going to cover from the first mode of paying dividends, the second mode of paying dividends, and the last mode of paying dividends. In this case, non-constant. So therefore, let's see. Okay. In this question now, non-constant dividend growth rate is a bit tricky, but it's a very simple exercise. So let's see now, how do we calculate non-constant dividend growth rate? So it's a very common question in exams. Example there. A company has just paid 10 shillings as dividend per share. Has just. Is it D1 or D0? It is D0. Has just paid. That is the current dividend. So therefore, D0 is equals to 10 shillings. Correct? These dividends are expected to increase at a rate of 15% for the next 2 years. So growth rate now will be 15% or 0.1 for 2 years. For 2 years. Correct? Years, followed by another growth rate of 10% for another 2 years. So another growth rate now, growth rate 2 is now at the rate of 10%. Then growth rate becoming before the growth rate becoming constant at the rate of 5%. So there is another growth rate 2, or yeah, let me call it 2 of what? 5% to infinity. Infinity. Now when you look at this question here, they have just paid the dividends, that is D0. Then the dividend, this 10,000, this 10 shillings here will grow at the rate of 15% for 2 years. Then that is year 1 and year 2. The third year and the fourth year will grow at the rate of 10%. Then year 4, 5, 6, continuously to infinity, it will grow by what? 5%. So you can see that there is no, the growth rate is not constant, but it's keeping on changing. Correct? Then the cost of capital is 10% required. Determine the theoretical value of the shares. So that is this how you do it. Now, we have the years. How many years we follow now? In year 1, D0. D0 is the current year. So we are not going to include this. We call it X dividends. So year 1 and year 2, this is period. Then, under these 2 periods here, the dividends are growing by 15%. So the growth rate now it is now 10 into brackets 1 plus G. G in this case is 15%. Power 1. Get the figure. Then 10 into brackets 1.15 power 2. You get the figure. So if you calculate that figure correctly, you will get here 11.5. And this one is 13.23. This is now the dividends. This is now the DPS. Correct? Now, this DPS here, after the second year, the growth rate will be at the rate of 10% per annum for how many years? 2 years. So therefore, that is year 3 and year 4. This figure here, 13.23, will be growing at the rate of 10%. You can see that. If you work it carefully with your calculator, you will be able to find 14.55, and here you will get 16.00. Then thereafter, after the fourth year, 5th, 6th, 7th, and to the infinity, it will be growing at the rate of 5%. To infinity, I want you to get that point right. 5th year to infinity is calculated as d0 into brackets 1 plus g over ke minus g. Ke minus g. When they say to infinity, what should come in your mind is this formula here. Therefore, now the fifth year, you have to take it from 14th year, which is 16 into brackets 1.05 divided by cost of equity. In this question, we have been given cost of equity as 10%, which is 0.1 minus 0.05 for that matter. So if you subtract, if you work out this question correctly, you are supposed to get 338. So there are four, you see, order. So from the fifth year to infinity, you are able to find out the value for the dividends is 333. Now, why are you given also the theoretical value that is required here is what we call present value. Therefore, in this case, I have to discount this because this 11.5 is at the end of year 1. What is this at the beginning of the year? So that means discounting. This 13.25 is at the end of year 2. What is it at the beginning of the year? So I have to discount these figures here for me to get the correct value. Therefore, I will be forced to calculate present value interest factor at the rate of 10%. At the rate of 10%. This one 10% is for discounting purposes. Now, years are following each other here. Look at what is happening. This is not annuity. Because it is not annuity, how do you calculate this? How do you calculate that, class? If you go back to our previous video about the time value of money, I explained this thing very well. That if years are following each other like this and the amount is not constant, that is not constant, that is not infinity, we now just need to say it will be 1 plus r power negative n. Correct? The years are following each other like that. Now, let's see. If you calculate now this very well, 1 plus r power negative n, the first year, for the first year will give you, put your calculator very well, you will get first year will be 0.9091. Your calculator, you just say power 2 for year 2. This will give you 0.8264. In year 3, you just remove n, you put 3 there. It will give you 0.7513. And for year 4, it will be 0.6830. Now, remember, this present value interest factor rate can also be obtained from the present value tables. So this particular present value interest factor rate, you will get it from the present value table. Therefore, it means that this one you can either decide to calculate or get it from the table, but it is easier to calculate because you might find a rate given there that is not in that particular present value tables and you miss the mark correctly. So I'm saying for us to calculate this one, you just say into brackets 1 plus r power negative n. N is the number of years. If it is year 1, you put year 1, year 2 like that, and you get the figure. Now, when it comes to the 5th year continuously, we don't know exactly which year we are dealing with. Because we don't know, we are going to use this discounting factor here to discount the figures to the infinity. For that case, it will be now this 0.6830. So for us to get now the present value, we just multiply now the cash flow times the discounting factor. Cash flow times discounting factor, cash flow times discounting factor until we get the figure. So now let's see. This times this, you get your discounting factor to be 10.45. The second one is 10.93. The third one is 10.93. Another one is 10.93. And then this one here will give you 229.45. Now, for us to get now the theoretical value, I have to get now the total value of the present value. Therefore, theoretical value, when you add all this one now, you get 272.76. That is your That is now example 1 in relation to non-constant dividend growth. Okay, let's see the example 2. I see whether you have mastered. Example 2. I want to see whether you have mastered. Now example 2, similar. A company expects to pay, they are saying expects to pay 12 shillings dividends per share for the year ending 31st December 20x9. That is now D1 because they are expecting to pay. But the previous example says that the company has just paid. That is D0. So I want you to see how we are going to calculate the two. Where is the difference? The difference how you are going to substitute in your computation. Now, then 20x by the end of year 31st December 20x9. The annual growth rate in DPS is expected to be 15% per annum for the period ending 1st of January 20x9 and 31st December 20x14. Thereafter, the growth rate is expected to be 10% per annum, given that the cost of equity is 13%. Required, determine the intrinsic value of the share as at 31st December 20x14. So let me read the question again. A company expects to pay 12 shillings dividends per share for the year ending 31st December 20x9. So therefore, that is D1. So D1, in this case, you have been given as 12 shillings in which year? 31st of December 20x9. The annual growth rate is in DPS is expected to be 15% per annum for the period ending, or the period between 1st of January 20x9 to 31st of December 20x14. So how many years are those? So let me see now. If I can now show these figures, I will now say 20x09, then 20x10, 20, this is 20x11, 20x12, 20x13, and then 20x14. These are years. 20x01, 09, 20x10, 20x11, 20x12, and 20x13. So the dividends are supposed to grow. So by the end of this year, this period here, the DPS in this case, D1, that is at the end of 20x9, it will be 12 shillings. Then 20x0, 20x10 now, it will be 12 into brackets 1 plus G in this case is 15 shillings. 1.1 that power 1. This is like it is starting because 20x9 is the end of the year. Now, when you now want to grow the dividends, it should now start from 20x11. So I want you to look at the difference between this question and the previous question. Now from there, it will still maintain 1.15 power 2, 12, 1.15 power 3, then this one is 12, 1.15 power 4, and then this one is 12, 1.15 power 5. So you can see, then when you calculate that carefully, you will find here being 13.8. This is 15.87. This one is 18.25. This one is 20.99. This one is 24.14. If you work it correctly, you get this figure. Now this is just down, but if they are paying at the end of the year, what is the value of that at the beginning? So it is telling you have to discount. So you now say, okay, what is my present value interest factor? At what rate? Cost of equity there is 10%. Cost of equity is 13, sorry, at the rate of 13%. Now, because these figures are not constant, we cannot use the annuity. We use just the normal present value interest factor rate In this case, I've said it is 1 plus r power negative n. So n is the number of years. So for year 1, if you substitute this one, you get the figure you get for this is 0.7831, 0.6931, then 0.6133, then 0.5428, then 0.4803. Then what happens after this one? So you can now get the present value. So dividends times the discounting factor, you will get here 10.8068. This one is 10.19931. 20x1. Sorry. This one will give you here is 0.8850. This one is 0.7831. This one is 0.6931. Then this one is 0.6133. This one is 0.5428 and 0.4803. So you multiply now with the cash flow. So this one will be, the first one will give you 10.62. This one is 10.8068. This one is 10.1931. This one is 11.1930. This one is 11.3923. And this one is 11.5927. That is up to 20x14. Now, but there is an additional information that are saying thereafter, that is after 20x14. Therefore, thereafter from 20x15 to infinity now, automatically to infinity, we have said, you say P0 into, sorry, not P0, but D1 into brackets 1 plus G over KE minus G. So this one is from immediate, this D0 is now the immediate value here, which is now 24.14 into, it will grow by what rate? It will grow by 10%, which is 1.1, then over KE 13, which is 0.1 minus 0.1. So when you work out carefully, you will get 884. It's 884 shillings point 998. So I've said, because you don't know which year we are dealing with here, the discounting factor will be the immediate present value. So present value in this case will be 0.4803. So when you multiply this one, your answer you get is 425. You will get 425.044. If you add now the present values, theoretical value, you will get 491.0687. So this is what we call intrinsic value. So your intrinsic value or theoretical value. That is how you are supposed to work on that particular element. Now, we got the last part of valuation of shares, which is called preference shares. Preference shares. So how do we value the preference shares, class? Preference shares are valued based on the market price. So therefore, for me to calculate the preference shares, I will just take DPS over KE. And in most cases, also when you are issuing these preference shares, it is affected by what? It is mainly affected by your by flotation cost, which is F. That flotation cost will automatically affect your market what? Price. So let's see from the question that we have there. There is only one question for that particular element. There's only one question there. The question says an 11% preference shares has the following characteristics. A. Par values, that is PAR, not PER. Par value per share is 100 shillings. Share price currently at 100 shillings. The flotation costs amount to 4 shillings per share. Determine the cost of preference share per share. Cost of preference. So they want to calculate this. So therefore, KE is equals to DPS over P0, but it's affected by flotation. So therefore, DPS now here, we have not been given the dividend per share. So you have to calculate by yourself. For you to calculate the dividend per share, you just take the percentage of dividends per value of the par value. So in this case, you take 11% on the par value. Par value is 100 shillings. You get what? 11 shillings. Therefore, my KE is given by dividend of 11 shillings over market value. I've been told is 100. I've been given also the flotation cost of how much? 4. So my answer will be 11 divided by 96. So if you work out and multiply by 100, your answer is supposed to get is around 11.46%. So the rest will be the same. The rest will be the same. So therefore, for the preference share capital, the formula to calculate is this one. And if you are asked to calculate the cost of preference share, you are supposed to calculate it like cost of equity, like the same, and you get the answer. Therefore, what is very important is that you are supposed to know how to discount the cash flows. Cash flows in this case are what? Dividends. So you have to know how to discount the cash flows. When do we say D0? When do we say D1? Very important. If you fail to get those points right, you will end up mixing up this computation. Number 2, you are supposed to know at what time do we calculate the dividends to infinity. Different to infinity, cash flows or dividends to infinity, we have said it will be D0 into brackets 1 plus G over KE minus G. But if the dividends are following each other, like the examples I've just said, we don't. But until we reach a point whereby we don't know the period in which we are dealing with, that is the time now we bring this particular formula. So next lesson will be valuation of bonds. Next lesson, that is tomorrow, we shall be discussing about valuation of bonds. Bye. Welcome again.